拼多多疯了吗？砍一刀砍到自己身上了。
Has Pinduoduo gone mad? The company seems to have cut its own throat. Last night, Pinduoduo's stock price plummeted by 28%, wiping out 55.5 billion in market value overnight, equivalent to the entire market cap of NetEase. This also led to a 40 billion drop in the personal wealth of its founder, Huang Zheng. On August 9, Huang had just become China's richest person with a net worth of 48.6 billion, surpassing the founder of Nongfu Spring. But after only 18 days as the richest person, he has already ceded the title back to Zhong Shanshan. So what's going on with Pinduoduo to cause a 30% drop in just one day?
拼多多自砍了一刀。
On August 26, Pinduoduo, the Chinese e-commerce platform and operator of Temu, released its second quarter earnings report. Following the release, Pinduoduo's US stock price plummeted in pre-market trading, dropping by as much as 28% at one point, erasing nearly all its gains since October last year. This marks the largest single-day drop in Pinduoduo's stock price since the US listing in 2018. Oddly enough, Pinduoduo's second quarter financial report was impressive. Revenue reached 97 billion yuan, 13.4 billion, an 86% increase year-on-year. Adjusted operating profit was 35 billion yuan, $4.5 billion US dollars, a 139% year-over-year increase. Adjusted earnings per share were 3.20, up from 1.45 the previous year, and exceeded analyst expectations of 2.73. Such stellar performance would typically be a significant boost for most publicly traded companies. So why did Pinduoduo's stock price plummeted? Many Western media outlets believe that despite Pinduoduo's strong second quarter financial data, its revenue fell short for expectations by 3%, as the market had expected 100 billion yuan. However, this is likely not the main reason. Many analysts believe the stock price plunge was driven by comments made by Pinduoduo's management. Typically, during earnings calls, the chairman of a publicly traded company will paint a rosy picture of the future and to gain shareholders and market approval, boosting the stock price. However, this time, Pinduoduo did the opposite. During the press conference, Chairman and co-CEO Chen Lei stated, "Our global business is facing a more severe and rapidly changing international environment. Our operations are increasingly disrupted by non-commercial factors, leading to significantly increased uncertainty in future business development, and a gradual slowdown in revenue growth is inevitable." Chen also mentioned the company faces intense competition on multiple fronts and is still in the investment phase. "We do not plan to conduct share buybacks or issue dividends for the next few years." He further stated that the company would sacrifice some profits to ensure long-term healthy growth and would waive 10 billion yuan in fees for high-quality merchants over the next year. Chen's remarks forced investors to rethink the positions. He was essentially telling them that Pinduoduo's future performance might decline. Moreover, he indicated that there would be no share buybacks or dividends in the coming years, a major blow to long-term investors. If the management is pessimistic, why should I stick around? Additionally, the company's decision to waive 10 billion yuan in fees spooked investors. So, what problems are plaguing Pinduoduo, a company that has been outperforming other e-commerce platforms for the past 2 years, leading to such statements from its top executives? First, from the financial report, we see that its quarter-over-quarter revenue growth slowed from 38.9% in 2023 to 11.8% in 2024, also falling short of the first quarter's growth rate. This slowdown reflects the company's struggles to maintain traffic growth. Additionally, Pinduoduo faces issues with product homogenization and merchant attrition. Recently, Pinduoduo's overseas platform Temu has been facing constant troubles. At the end of July, hundreds of Temu merchants gathered at the company's headquarters in Panyu, Guangzhou for a collective protest. Some merchants stormed the office area, disrupting normal operations at Temu's headquarters. This protest continued until August 26, the same day Pinduoduo's earnings report was released. The protest began on July 22nd when a dozen of merchants went to Temu's Guangzhou headquarters to demand answers regarding platform fines and withheld payments. On July 29th, the protest escalated to include around 800 merchants. They claimed that they were fined and had after-sale reverse funds deducted by the platform, with amounts ranging from tens of thousands to millions of yuan. With no other resource, the merchant decided to gather at Temu's headquarters to seek answers. Earlier this year, Temu's fines on platform merchants sparked controversy on social media. The platform enforces strict fines for issues like logistic delays and product quality, with some fines being imposed months later, making them difficult to anticipate and correct. These hefty fines have become a significant burden for merchants, who criticize the platform's lack of transparency and feel like they're playing a minesweeper game where hidden fines could be triggered at any time. Merchants also believe that while Temu's growth in 2023 was impressive, much of its success was due to these high fines. Especially after Temu implemented its fully managed operations models where the platform handles everything from pricing to sales, fulfillment, and after-sale service, merchants, despite paying significant promotion fees, they have been reduced to mere product suppliers. The platform continuously squeezed merchants to retain customers, forcing them to accept lower prices and various fines and fees. Many Pinduoduo merchants are now at a breaking point, with any additional burden potentially being the last straw. Merchants initially chose Pinduoduo because its large traffic volume, which led to a quick sale, and because of its low barriers to entry and operational cost. However, when considering overall expenses, merchants realize that they're barely breaking even after a month of hard work. If the platform plans to squeeze merchants' profits from the outset, taking most of the profits for itself while sacrificing merchants, it's undoubtedly a case of killing the goose that lays the golden eggs. This approach is also dampening enthusiasm among Chinese cross-border sellers, which is one of Pinduoduo's biggest internal challenges. Some merchants, finding it increasingly difficult to sustain their operations, want to exit the platform but face significant challenges. The main issue is that Pinduoduo holds their substantial deposits, and when merchants apply to exit, the platform finds various reasons to withhold these deposits, which has caused considerable dissatisfaction. Pinduoduo's success and the way it has generated high profits through in line with the current trend of consumer downgrading is inseparable from its relentless exploitation of merchants. However, this approach is not sustainable, and it has now led to collective resistance and even desertion by merchants, a burden that Pinduoduo cannot afford to bear. This is likely why CEO Chen Lei announced a plan to waive 10 billion yuan in fees for high-quality merchants in the coming year to retain merchants and maintain the platform's operations. Moreover, Temu's aggressive expansion to the US and European markets with cheap, low-quality products has polluted the overall business environment and has drawn the attention of several countries, prompting them to draft laws to protect their markets and consumers. For example, the Dutch government recently decided to impose taxes on imported parcels from outside the EU, a move seen as a response to Chinese online stores selling tax-exempt goods in the Dutch market, benefiting significantly from the import tax exemption at low-cost parcels. The US is also considering legislations to prevent platforms like Temu and Shein from exploiting tariffs loopholes to dominate the market. Reports suggest that Temu and Shein have taken advantage of the de minimis exceptions to flood the US market, accounting for 1/3 of all imported parcels. The reports cite data showing that US retailers importing t-shirts from China must pay a 16.5% tariff, a 7.5% China-specific tax, and custom and broker fees. This helps explain why Chinese fast fashion retailer Shein can sell women's clothing for 39% to 60% less than H&M. According to a recent US Congress report in 2022, H&M and Gap paid $205 million and $700 million respectively in import duties, while Temu and Shein paid nothing. The US Congress is currently drafting a bill to remove taxable goods from the de minimis exemption. Some lawmakers are also proposing to lower the exemption threshold to match that of trade partners such as China's $7 exemption limit. This is a major concern for Chinese e-commerce platforms like Temu and Shein. If the de minimis exception is removed, their cost advantages will be significantly reduced. This could be one of the reasons why Chen Lei gave such a pessimistic market outlook. There is also speculation about why Pinduoduo chose to downplay its own stock value, with two main theories. First, by reporting earnings below expectations, the company may be trying to squeeze out some of the growth hype and then buy back shares cheaply when the Federal Reserve potentially lowers interest rates in September. Second, Pinduoduo founder Huang Zheng may not want to be the richest person in China. With the stock price down, he can return the title to Zhong Shanshan of Nongfu Spring. This speculation is not without merit, as Huang's low-key personality suggests he may not desire the spotlight. In June 2020, Huang Zheng's wealth surpassed that of Jack Ma, reaching 321 billion yuan, second only to Tencent's founder Pony Ma, who had 364 billion yuan at the time. With Pinduoduo's smallest market cap and rapid growth, Huang was set to become China's richest person. However, in 2021, just before taking the top spot, Huang donated 100 billion yuan, stepped down as CEO, and later resigned as chairman, aiming to retreat from the limelight and focus on food and life sciences research. His low-profile nature is evident, but things didn't go as planned. 3 years later, amid China's consumer downgrade, other e-commerce platforms have struggled, and the fortunes of other tycoons have dwindled. In particular, Nongfu Spring's stock price fell by 30% in the past 6 months, while Pinduoduo surged, maintaining growth against the trend. As a result, on August 8, 2024, Huang Zheng became China's new richest person. Being the richest person in China is no easy feat. Looking at the fate of previous Chinese billionaires, many ended up either arrested or forced to step down. For example, in 2004, Huang Guangyu, who first topped the Who Run Rich list, was sentenced to 14 years in prison in 2008 for insider trading, money laundering, illegal business operations, bribery, and tax evasion. In 2013, Wang Jianling, who became China's richest person after investing over 245 billion yuan overseas, faced a severe financial crisis and found himself saddled with 400 billion yuan in debt, earning him the title the richest debtor. In 2014, Jack Ma, who became the richest person, has since disappeared from public view under pressure from the CCP. And Zhong Shanshan, who became the richest person in 2021, resigned from all of his positions for personal reasons. So it's understandable that Huang Zheng might be eager to shed the richest person's title. Unlike other billionaires whose wealth increased when the economy is strong and business is thriving, Pinduoduo's success has ironically came in an economic downturn. As people have less money and downgrade their spending, Pinduoduo's performance has only improved, highlighting a significant irony. Pinduoduo's rapid expansion has been built on gradually taking market share from its competitors, which naturally breeds dissatisfaction and envy. Additionally, as Pinduoduo's stock prices rise, the pressure on its platform merchants increases, leading to growing discontent and more conflicts. Therefore, management's warning about the influence of non-market factors and the significant uncertainty is not mere alarmism. From this perspective, Pinduoduo's decision to tamper its own performance and stock price, much like Huang Zheng's effort to shed the title of the richest person, can be seen as self-protection mechanism. Pinduoduo's success in China relies heavily on low-price competition, while Temu adds to this with overwhelming advertising and fines imposed on merchants. However, these business tactics are not a magic bullet. They are more like a sugar-coated poison with inherent unsustainability. Pinduoduo's strategies from the initial price cut to the current refund and no returns model have been key to its success and have forced other platforms to follow suit. While these tactics appear to benefit consumers, they often result in people buying a pile of subpar products that are ultimately a waste of money and societal resources. Platform merchants, squeezed by intense competition and continually falling prices, are left with minimal profit margins. To survive, they are forced to seek cheaper goods, which in turn pressure manufacturers to use low-quality materials to cut production cost. This is why Pinduoduo is flooded with counterfeit and inferior products. Pinduoduo's business model may be nearing its end. The China State Administration for Market Regulations interim provisions on online anti-unfair competition will come into effect on September 1st, 2024. This is the first regulation under China's anti-unfair competition law system specifically targeting online business activities. It strengthens the legal responsibilities of platform operators, including regulating competitive behavior within the platform and preventing unfair competition. Additionally, on August 22nd, 5 major e-commerce platforms, JD.com, Taobao, Pinduoduo, Douyin, and Kuaishou signed a self-regulation agreement for compliance in online transactions. The background to these policies is the increasingly fierce market competition in China, exacerbated by the rapid expansion of e-commerce, leading to numerous industry problems. Issues like unfair competition and counterfeit products have severely impacted consumers' shopping experiences. The signing of this compliance agreement aims to strengthen the management of online live streaming and short video marketing activities and to pave the way for the healthy development of the entire e-commerce ecosystem. Since the beginning of this year, numerous e-commerce platforms have been forced force into a price war led by Pinduoduo, resulting in extreme internal competition and intensifying market rivalry. Some argue that in the past, Taobao's Tmall and JD.com battled for the middle-class market, but with the middle class now struggling, Pinduoduo has outpaced them by catering to the needs of the financially struggling population through low prices and aggressive service expansion, profiting handsomely from ruthless merchants' exploitations while other platforms barely make money. In August, JD.com, Taobao, and Douyin were the first to exit the price war, announcing a strategic shift to focus on service-oriented business models rather than competing on price alone. So, who will be most affected by these new policies? Many people immediately think of Pinduoduo, which pioneered these controversial competitive strategies. Some analysts have even noted that while the new regulations do not explicitly mention Pinduoduo, they seem to target it directly, addressing issues such as fake sale figures, poor product quality, and misleading advertising. Some have likened Pinduoduo to a disruptive force in the market, undermining the last vestige of business civility in China and representing a distorted presence. However, can these policies truly change the chaotic state of competition in China's e-commerce sector? Many are skeptical. First, consumers have already developed a habit of comparing prices across platforms, and while platforms may publicly claim to avoid price wars, they will likely continue doing so in practice. Furthermore, the downward trend in China's economy is undeniable, and the trend of downgraded consumer spending shows no signs of improvement. If anything, it may be worsened. This means that the number of consumers seeking low prices will continue to grow. Even if platforms unite and internal competition eases, the shrinking market is a reality. The market pie is only so big. Whoever secures it will survive. So, where is China's e-commerce headed? How much longer can Pinduoduo's model last? These questions remain unanswered.